Bill Hornbarger, Chief Investment Officer for Benjamin F. Edwards, with a quick update on the May Federal Open Market Committee meeting. Well, as expected, the Fed raised the target Fed funds rate 50 basis points. That's exactly what the consensus had been, as indicated by the futures markets. The Fed also took the opportunity to lay out its plans for quantitative tightening, or put more simply, the runoff of the Fed's balance sheet. The Fed's been a huge buyer of bonds the last couple of years. The Fed announced that beginning June 1st, they will start to reduce the size of the balance sheet by $47.5 billion a month for 3 months through the end of August. And then beginning September 1st, they'll go to a larger amount, $95 billion per month. That'd be $60 billion in treasuries, $35 billion in mortgage-backed securities on a monthly basis as they try to, again, reduce the size of the balance sheet. In the statement accompanying the 50 basis point increase, the Fed did acknowledge some external factors as negatively impacting inflation. They talked about the war in Ukraine. They talked about the COVID-induced lockdowns in China leading to supply chain disruptions. I think the one thing that was a little bit interesting is the Fed acknowledged that they're paying special attention to and very attuned to inflation right now. Remember, the Fed has a dual mandate: growth and inflation, but clearly the elevated rate of inflation we've seen for more than 12 months now is weighing heavily on the Fed's mind, and today's activity is very specifically targeted to addressing that. I would characterize today as no surprise. I think it came right where the consensus thought it would: a 50 basis point increase in the target Fed funds rate. Rhetoric surrounding the Fed will be data dependent going forward, and then the reduction in the size of the Fed's balance sheet. The markets certainly took it in stride. Equities are higher after the announcement. Treasury bonds, little change from where they were prior to the meeting. I think the one thing that's interesting there is you would expect after that big increase, you might see a little bit of flattening in the yield curve, as actually we've had the opposite. If you look at the 2 to 10 year spread, it's actually widened about 3 to 4 basis points in the wake of the Fed announcement. And if you think back 3 or 4 weeks, there was a brief inversion in the yield curve between 2 and 10 years. It raised some of those concerns about a potential recession. So at least that one indicator seems to be that some of those fears are abating.